The U.S. Federal Reserve looks set to embark on a significant monetary policy tightening, at least for the next couple of years. And to quantify the potential impact on the monetary policy decisions across emerging market central banks, BNP Paribas ran an analysis which concluded that going by history, when the Fed sneezes, some emerging market central banks can catch a cold. For more, we are joined by Jeff Schultz, who's a senior economist at BNP Paribas South Africa. Jeff, thank you so much for your time. Before we get into the aspects of what this analysis brought out, what were you, perhaps let's go into why embark on this type of analysis? What were you trying to answer?
I guess the answer, the question that we were trying to answer is, what impact does the US Federal Reserve or tighter global monetary conditions have on the reaction function of a central bank like South Africa? And really, we conducted the analysis across 15 emerging markets, really to try and quantify how much does a Fed rate hike cycle actually impact on our own interest rate hiking cycle.
Historically, based on some of our subs' decisions in the past, have we immediately reacted whenever the Fed made a move?
So I wouldn't say immediately. South Africa has its own idiosyncrasies with regards to inflation, with regards to growth, our labor market. We're a very different economy to that of the US economy. However, we are also an open economy, which means that we are subject to tighter global financial conditions, higher interest rates out of the US, higher interest rates out of Europe, and because that impacts us indirectly through the currency. And currency, the weaker the currency, the more that can feed into things like inflation, higher levels of inflation, and that ultimately determines whether or not South Africa's Reserve Bank has reacted in terms of higher interest rates in South Africa. And what we found is that the Fed does matter. It's not the only component that matters for the South African Reserve Bank, but it is one of the components that does in fact matter in terms of interest rate hikes.
So there's been a lot of conversation in terms of what to expect for the Fed March meeting, whether it's going to be 50 basis points or 25 basis points, especially when you take in some of the comments that have come through from the different Fed presidents. When you look at a South Africa situation, a SABC situation, what do we have going for us in terms of buffers that we may have built over time, whether it's from a currency point of view, etc.?
Well, I think that's an incredibly important point, the buffers that have been built. And, if you compare South Africa today compared to where we were in 2013, which was the taper tantrum in the US, where the US started tapering its asset purchases and effectively implementing some form of monetary tightening in that economy. The rand sold off quite aggressively in that environment. We are not in that environment right now. South Africa has built up buffers in the form of high commodity prices, a current account surplus. We were running deficits back in 2013 of about 5% of GDP. We're now running very healthy surpluses, closer to 4% of GDP. And that means that South Africa's external vulnerability to US Fed rate hike cycles is much less today than what it was in previous rate hike cycles out of the Fed. So what we're arguing, and in fact, you're seeing that in the currency markets today, where we are now below 15 to the dollar. The South African rand is actually in the top 3 outperformers of emerging market currencies year to date. So these are the types of buffers that we think this time is slightly different for South Africa. The currency isn't likely to weaken significantly into a Fed rate hiking cycle because of these buffers that have been built.
Right. So the interesting part about your report, the title says, when the Fed sneezes, not all emerging markets catch a cold. Based on that, then, which emerging markets right now are sensitive to Fed monetary policy?
So we think, one, geographically, I think the Latin American countries tend to be more impacted by US Fed rate hikes. In particular, Mexico stands out as one, very close geographically. Their countries, their exports are very interlinked. And so they have very similar type of reaction functions to that of the US Federal Reserve. Colombia is another one. In the Central European and Middle Eastern African markets, South Africa is actually the standout in terms of reaction function to a US Fed rate hike. It's much lower than that of Mexico, But the bottom line is that a US Fed rate hiking cycle does matter for a country like South Africa, buffers or not. And that really underpins our expectation for the South African Reserve Bank to continue steadily hiking interest rates this year.
Right, so we've got that March meeting, and it's probably everyone's been talking about it, whether it's inflation or what the Fed is going to do based on that hot inflation that's coming out of the US. When we get to that March meeting, I mean, what will you be looking out for as the chief economist at BNP Paribas?
Look, I mean, I think the Fed is incredibly important in that respect. And I think the jury is still very much out with regards to whether or not we're going to see a 25 basis point hike out of the Fed or a 50 basis point hike. Certainly the higher inflation prints that we've seen out of the US of late, PPI inflation as well, suggests that a 50 basis point hike could be on the cards. And, you know, I think the currency's reaction, South Africa's currency reaction to that, I think, will be fundamental. But I think critically, if you look at the inflation numbers domestically that came out for South Africa this week, South Africa doesn't have as big an inflation problem as what the US is facing right now. US has inflation of above 7%. South Africa is sitting below 6% inflation, which is the first time in 40 years that South Africa has had a lower inflation rate than the US. So our reaction function doesn't necessarily have to be in step with that of the Fed, but we do think in light of a forward-looking Reserve Bank that wants to keep inflation expectations well anchored, that a 25 basis point rate hike is probably more likely than not out of the South African Reserve Bank, regardless of whether or not the Fed hikes 25 or 50 basis points next month.
Jeff, thank you so much for your time and for sharing those insights with us. That is Jeff Schultz, who is a senior economist at BNP Paribas South Africa, talking to us about the idiosyncratic moves that they are seeing when it comes to the different emerging market, especially the local environments, and how that relates to the Fed.